of everything written about how your investment strategies could be all wrong. The most important context keeps getting dropped from the main narrative. The moment the brokerage app dropped its quarterly performance scores last month, my inbox lit up like a slot machine that just paid out. Except this time the jingle wasn't excitement, it was dread. "Why did my portfolio underperform the S&P by 2.1%? One friend texted in all caps. Another forwarded a CNBC chyron flashing, "Bear steel market, your 401k is the target." The panic isn't just in the numbers, it's in how fast we throw the book at the numbers, expecting them to explain why we feel poorer, even when the market's up. Look, I've sat through enough market outlook webinars to know the script. Charts glowing green, voices smooth as butter, the usual time in the market beats timing the market mantra, belted out like a stadium anthem. But here's the thing I've noticed that no slide deck mentions. The same investors who swear by dollar cost averaging are the ones screaming into Reddit threads the second their ETF lags behind the latest meme stock surge. They're not practicing what they preach. They're treating their portfolio like a fantasy football team they can bench players from every Friday. If you're rebalancing weekly just to chase whatever ticker's trending on StockTwits, you've already admitted your strategy isn't a strategy, it's a hobby with a ticker symbol. The momentum I'm seeing isn't just more people opening brokerage accounts, it's the rise of the strategy roulette mindset. You pick an algorithm off YouTube, plug in your age and risk tolerance, and voila, your portfolio is automated. But most of these so-called algorithm gurus run backtests that conveniently start right after the 2008 crash and ignore the decade of zero interest rate zombies that followed. They'll show you a curve that looks like a hockey stick and whisper, "Just follow the signals." What they won't tell you is that the same signals would have had you buying meme coins in 2021 and selling them in 2022. Except by then the guru has already moved on to the next viral indicator. What's really shifting beneath the surface is our relationship with risk itself. For 20 years we've been conditioned to believe safe means index funds and bold means crypto. Never mind that an S&P index fund can drop 30% in a quarter and we act shocked, while crypto can erase 80% and we call it a learning experience. The cognitive dissonance is everywhere. We'll dump cash into a SPAC IPO with no revenue because the CEO looks good on CNBC, yet recoil at the idea of holding a single quality stock for 5 years because it feels risky. The truth is that most investors aren't risk-averse, they're loss-framed. The second an asset dips, their brain screams loss, and their strategy collapses into panic selling, only to chase the next high after it already ran. I watched a friend do this exact dance with Tesla during its 2022 plunge. He bought at $400 because Elon tweeted something hopeful on a Thursday, then sold at $250 the following Tuesday because a TikTok influencer claimed the stock was dead money. 2 months later, Tesla ripped back to $400, but he wasn't around anymore. He'd moved his cash into an AI crypto play that promptly dropped 60% within a month. His mistake wasn't bad luck, it was chasing volatility instead of understanding compounding, and no algorithm or guru could fix that, because the math wasn't the problem, his psychology was. Here's what I've come to believe after watching hundreds of portfolios go sideways. Most strategies fail not because they're wrong on paper, but because they weren't designed for the investor who actually uses them. Your uncle's 1990s rule of never time the market worked fine when he was buying blue chips with a dividend check every quarter. But if you're chasing whatever's flashing on your phone while your coffee's still hot, you need a plan that fits a phone-scrolling, headline-grazing brain, not a 1950s Dow theory manual. Let me give you a concrete scenario that trips up even disciplined investors. Say you set up a simple 60-40 portfolio, 60% stocks, 40% bonds, back in 2021. Over the next 3 years, stocks zigzagged, while long-term bonds got crushed by rate hikes. By early 2023, your 60-40 looked like a 70-30, because bonds had shrunk while stocks stayed roughly flat. Most investors would look at that and think, I'm too heavy in stocks now, and sell some equities, locking in the recent gains and missing the bond bounce that started later that year. Every time you rebalance based on where the portfolio is today, you're essentially betting against mean reversion, and mean reversion is the only thing that makes balanced portfolios work. What's growing in momentum right now is the quiet rebellion against set it and forget it. Not because the idea is flawed, but because forgetting it is human nature. The new wave of advisors isn't selling you a static allocation. They're mapping your portfolio to your actual behavior, not the spreadsheet version of you. One firm I know uses a simple 2-sentence risk tolerance quiz. When your portfolio drops 10%, what do you do? And when the market rallies 10% after a crash, what's your first thought? If your answers are check the balance every hour and buy more, no 100 minus your age rule will save you from yourself. They build you a dynamic sleeve that scales back when your pulse rises, no formulas, just a dial that tightens when the brain fog sets in. The shift I'm most excited about is the return of margin of safety as a mainstream concept. Not because Warren Buffett tweeted it, but because the last 3 years of boom and bust cycles made plain that buying the darlings at any price is a losing game. I've seen investors load up on high-flying AI stocks at 50 times sales, only to watch them cut guidance and erase 40% in a month. Meanwhile, a boring semiconductor company with stable cash flows and a reasonable PD held firm and even bought back shares. The outperformance wasn't magic, it was the absence of fantasy baked into the price. Still, let's be real. Embracing margin of safety doesn't mean you skip the roller coaster. It means you ride with the bar down and the harness locked. I'll give you a quick trick I've stolen from a value fund manager. I call it the 2-week rule. Before you buy any stock or fund, put the ticker on a watch list and wait exactly 14 days. Don't look at the price. Just note what changes in the business or news. After 2 weeks, ask yourself, would I buy this same asset at its current price right now, knowing everything I just learned? If the answer isn't an emphatic yes, you've just dodged a trade you'd probably regret. Most people skip this step because the market moves fast and our dopamine spikes faster. But the 2-week gap is where discipline beats volatility every time. Another angle that's gaining traction is lifestyle investing, which sounds fluffy but has teeth. Instead of asking, what return can I get? It asks, what return do I actually need? If you're saving for a house down payment in 4 years, you might anchor your risk around instruments that mature close to that date and leave the rest in cash. If you're funding a startup idea in 7 years, you can afford more equity exposure, because the timeline gives you time to ride out drawdowns. One founder I know stopped sweating every market dip once he realized he wouldn't touch 80% of his portfolio for a decade. He moved his liquid money into ultra-short bond ETFs so he could sleep at night, and the rest went into a simple indexed global equity sleeve. No stock picking, no leverage, just a schedule that matched his life, not the other way around. The biggest mistake I see isn't chasing winners, it's ignoring the silent killers, fees and taxes. A friend with a 6-figure 401k still pays an all-in fee